Hi everyone, welcome to this new episode. Last 6 months, basically 2 quarters, have been really crazy. Markets have fallen and fallen a lot. Markets have recovered from the bottom, and we are staring at roughly every stock being up 20-30% up from the recent bottoms. And it's a really tricky decision right now whether you should stay out or put some money or put a lot of money, especially if you've not added money at all till now and sitting on cash. In this video, I'll talk about last 6 months, my journey, what are my key learnings, improvements that I have tried to make in my trading journey, investment journey. And let's see if any of these can benefit you. You can cherry pick the ones that you like. I'll talk about 5 key points, investing in events, and I've covered this topic many times in the past also. Sector-based themes, if you have watched my regular updates, the daily ones which I used to do a couple of months back, then I used to cover a lot of these sector-based themes, how I'm managing my capital a little differently from earlier, broad-based strategy changes that I have done for myself and my own personal evolution. And I'll talk about bads and goods both in this particular video. Now, investing in events can be really fruitful or can really destroy your capital depending upon how well you read the events. There are various kind of events that impact the stock prices. I'm talking about volatile movements in the prices up or down. Results are the biggest ones, of course. Good result, bad result. Budget, here I'm talking about the annual budget of the country, not the company's budget. Rebalancings like the MSCI ones, the European ones also. These are times when stocks are included in global indices. As a result, a lot of investor activity happens. This could also be an exclusion, which means the investors will take money out. You could also have events related to inclusion or exclusion in the local indices like say Nifty or Next 50. Typically when a stock is upgraded to a Nifty stock, it is removed from Next 50 and added to Nifty, which means investors of Next 50 actually exit and the ones in Nifty, they add the stock to their portfolio. You could have events like bonuses, rights issues, as well as dividends. Now, there are certain events that I have tried to call out in the past 6 months, 1 year actually. I have called out the crash in India and I called it out too early. That is why I put it in the bad window. What that means is I sold my stocks too early. I went short and I lost opportunities to make money. The other side effect of this approach was I also invested back in the stock markets in feeling of missing out, which is FOMO. As a result, I got caught at the top in many good high quality stocks, but at a very high price. Now this had two side effects. One was if I had to exit, I had to exit at losses. And second is if I didn't want to exit, I was ending up with a lot of blocked capital. Both of these are bad for my portfolio. Note that investors can't make money in the falling markets. They have to wait to invest low and sell high. If they've already bought, then they can't make money. Technically, they can go short, buy again at a lower level, but then capital erosion is there. Your capital reduces, your holding prices comes down. You could also have some sort of tax harvesting happening, but the money is not made. Money is made only when you sell at a higher price. Now, corresponding to this, there is also a set of goods. I also called out the crash in US markets after the US elections. So I prepared my portfolio for a November end correction in the US market. What I did to prepare for that was I invested in gold pretty early. My thought at that time also was that the US markets, if they crack and crash, then they will take down the global system with them. And at that time, gold will go up as a hedge against uncertainty. This particular part has played out perfectly. Gold is at an all-time high. Markets in the US have crashed a lot. In fact, Indian markets fell 12-13% in about 6 months' time. Dow Jones, Nasdaq, about a week back, they cracked 12% in just 2 days. Now, some people may not call it crash, they may call it correction. That's okay. Now, one thing I have done of late, especially after the last 2-3 weeks, is that to cut out my particular stress level, I have gone out of the event evaluation completely. Yes, events will happen. You can predict at macro level, but you can't plan micro investments or trades according to how the event will play out. It will not play out the way you want in general. And whenever I have a very high conviction for an event, I do still trade into it. But I trade with very limited capital. Earlier, I was at times trading with 5-10 units, even more at times, which was very high. And if the event did not happen the way I thought, then I was getting stuck with several thousands or even lakhs of losses for several quarters. So this change has helped me a lot in specially containing the losses in adverse events, where event has not played out the way I thought it will play out. The most recent example where I had this happen was in two stocks, MRPL and Varun Beverages, both where I had very high conviction, and in both I lost a lot of money. If you have seen my daily updates in the past, you would know how fond I have been of late, especially of sector-based Trading and investments both. Sectors come in flavor, sectors go out of flavor. Why I say also investments? If you are investing for a longer term, then sectors which are out of flavor right now. For example, maybe you call it IT as right now out of flavor because of the situation in US. And if you're a long term investor, it may make a lot of sense to invest because the stock prices may be lower than normal. Now, an example where I lost a lot of money recently in microfinance. I got this reading completely wrong. If you see in this particular column, these stocks have recovered significantly from their bottoms. For example, Spandana Spurti is up 30% from its bottom, the recent one. It is still 250% away from its all-time high or 52-week high. Now, Fusion Microfinance came up with a rights issue, so they were dancing in joy 9.2% up. This stock had fallen to 60% nearly. Spandana was up 7.6%. No, they are not coming up with any rights issue. But sector-based approach, the entire sector starts dancing. So in terms of calling out what I could have done better, one is obviously the MFI example which I just took. I totally underestimated the longer-term impact of windfall tax. I thought it is a 1 quarter thing or 2 quarter thing. I never factored in that because of the elections, the windfall tax will not be removed even if the crude prices crash. The impact on oil companies was so severe that in my opinion it will take at least 1 to 2 years, especially for E&P companies, extraction and production. These are the typical Reliance, Oil India and ONGC kind of companies where the margins depend upon the crude prices. If prices are low, then it makes less sense for them to do the business or they make lesser money. The E&P companies as well as oil marketing companies, they have not done too much investment into say green energy and increasing their capacity, and this kind of takes us back by 2 years in terms of progress. Windfall tax has not been good for the country and the entire oil and gas pack. Note that in my opinion, windfall tax was created just to take the tax out of the largest producer Reliance, just that this tax never got removed when the crude prices came down. That is why you will also see, because of many other reasons also, Reliance has not done well at all in the last 1.5 years. I also went against the wave in Airtel, HDFC and Infosys. If you see my video on the expectations from election results, which I had shot around May end or something, I had called out that Airtel will do very well, but I did not invest in Airtel. So while my analysis was still there, I have gone against HDFC also, I have gone against Infosys also. That is why I thought that the business models are a bit shaky. What I underestimated was all three of these are favorite stocks of FIIs. ICICI also to some extent. Also, there are sectors that I still don't understand, like pharma, fertilizers. Pharma is expected to do a lot better, but right now I don't see a reason why it would do well. Right now I see that US is putting all sort of commotion and problems for each and every sector in India which exports to US, including pharma. And we have so many generics and specialist companies, also arms of American companies, that the impact could be huge. US is a big market for pharma. Now coming to goods, I have developed a sectoral model so that even if I don't understand the sector, the model will tell me that this sector is doing well or expected to do well. As a result, at least I can trade, if not invest long term, not miss out on the opportunity. For investors, the opportunities could be ample. But what happens is their favorite sectors or invested sectors, they could stagnate. Like for example, banking stagnated, especially the large banks, HDFC, Kotak, they stagnated for a while. Right now, Reliance is stagnating. So your investments could get stuck for a while. If you are not trading, then you might have a stagnant or a downward direction for your portfolio for a significant time. Yes, in the longer run, you will do well because the economy will go up. Now, the good part also is that I didn't invest in IT and IT has come down a lot. A lot of my friends who were against my philosophy, they invested in IT. Right now, they are stuck with anywhere between 15, 20, 25% losses. The results of the IT companies till now also have not been that great. The same sectoral approach has helped me make decent money in defense and investment banking. It also made me get stuck in certain stocks, like for example, Motilal Oswal, Angel One. I didn't observe the sectoral shift, or I kind of got overconfident. I didn't take the money out of those stocks. Also, based upon the sectoral analysis, I called out the consumption dip and I exited HUL literally at the top as soon as the prices seemed to be peaking and the sector showed a reversing trend. I booked losses in many. For example, I booked losses in Asian Paints, DMart, came out, and those stocks fell a lot after that. Now, during market crashes, one of the very important topics is capital management. We don't have infinite money, and most of us run out of money when the markets are nearing the bottom or whenever there is a big crash. One thing to note is that in my older strategy, I had significant equity capital which was involved all the time in trading. As a result, my liquidity will be low if there was a big opportunity. Also, in general, my approach was to trade in investment grade stocks. What that means is if those trades were to go wrong, then they would become investments. Also, I was doing a lot of tracking at that time because I had 10 plus stocks in which trades were going on at the parallel in the same time. The good part is in my capital management, I moved a lot of money to bonds and FDs. As I near the age of 50, I don't want a lot of money in equity markets at all. Bonds give cash flow, and FDs I've talked about in past also, they help me leverage because I take overdraft against them. In fact, recently I did a major transaction where I had some cash available. I moved most of the money to FDs, took an overdraft because I don't want to invest into equity markets at this juncture. I don't think equity markets are going to create a bottom for next 1 year, 2 year. What that means is there could be a new bottom at some point of time in future. One thing I'm not sure of is the long term dead for now, especially because there is so much happening around us. Politics has gone crazy globally. US markets go up and down trillions of dollars in a day. And I've talked about SIPs, SWPs theories. I have not got the courage till now to invest major money in SWPs to withdraw on a monthly or a quarterly basis. I somehow am not be able to digest the philosophy of SIP myself and have not as a result gotten into it, though I want to. But no SIP, SWP as of now have given me one advantage, that my capital has not got locked at a higher price. Now if I stay out for longer and the markets go up, I miss that opportunity of course. With so much changing around us, I obviously had to make certain tweaks to my strategy. There were few things which were not working for me at all. One of them was options. I have tried buying, I have tried selling, I have tried to do risk management, but somehow this instrument has never worked for me. I've tried intraday primarily to encash on selling opportunity for stocks that I don't own. Tried that, didn't work out. For liquid stocks, for large stocks, it becomes very easy for large players to manipulate or manage rather. As a result, I've tried futures of late. Futures have few advantages. One is it gives you leverage just like options does, but there is no compulsion to close the trade on the same day. That does not mean that there is lesser risk with futures. You could have money evaporating very fast in futures also because it is a leverage trade. I have also tried international commodities of late: gold, silver, crude, natural gas. One advantage is these are calibrated with international prices and movement. So it is not very easy for a large player to do a bulk dump or bulk buy sell and manipulate or manage the prices in the domestic Indian markets. You can't do a dump of 8-10% in gold or 5% in gold silver if the international prices are not moving in the same manner. One thing to note in commodities is MCX closes around 11:30 in the night and international trades go on for a few more hours. As a result, when you see MCX opening at 9, you typically see a gap up or gap down in most commodities to align with the international closing. In the worst case, in one specific day, I lost my conviction and I lost 70,000 on natural gas. That is when, because of the extreme cold conditions in US, the natural gas prices went up, I think 15-20% in a single day. I've tried crypto the legal way, CoinDCX, the way the government wants us to. I took a leverage. I lost 1 lakh rupees in a single day. That's because I took a leverage trade 1:10 on Ethereum, and Ethereum that night crashed 13%. Totally out of control black swan event, but just happened on the day I took the position, so I bowed out. This is probably not my cup of tea. One thing which has not worked for me in the past, and I don't prefer it when the markets and stocks are falling a lot, is averaging, because you don't know till what extent they will fall. I've tried creating elaborate models on things like greed and fear. I keep on tweaking and tuning the models. They typically don't help me take better trades because there is so much data around us. How to imagine everything that goes into a model? I've tried to use a lot of indicators. I've gone overboard with them and I've stopped using certain providers. They have not worked for me. data issues, policy issues, and so on. I'm not saying they are bad. They could be your favorite or they could work well for you. 3 out of 5 trades is a philosophy I've followed for a long time, thinking that if I get majority of my trades right, then I'm doing well. No, this philosophy is flawed for a simple reason that if you are getting 3 out of 5 trades right, you are effectively having one win in 5, which means after taking risk and blocking capital and paying a lot of commissions, margins, STTs, etc., etc., you end up with one win out of 5 in the best case. That is not good. I've graduated from averaging to laddering, which means buy when the stock starts going up. This is very interesting, flipping the trade if the trade has gone wrong. For example, if I have bought something for $100 and it goes to 95, then I would flip the trade, which means instead of +1, I would say -2 in quantity. So the trade flips as -1 effectively with a booked loss of 5 rupees. Now the stock is going down, so you carry on till the stock is on the downtrend. Your reading was wrong, that's okay. But now don't make it worse. When your indicators say that the down part is going to reverse now, then you flip again, maybe +2. That way you align with the right expected direction once more, but you have recovered a bit of loss. Like I said, I have reduced the indicators. The prime one I use is RSI. Obviously, the volumes are important, so increase and decrease in volumes. I've made enhancements in my software. For example, I've added graphs for quarterly EPS, annual EPS, which help me a lot. I have also taken a subscription for TradingView, which is helping a lot because that is streaming data. And I continue to use the commercial license of Screener while it has its own limitations. One thing I've done is I've switched to Motilal Oswal software of late, especially for FNO and commodities. It is very good. One good part is that trade platforms like Motilal Oswal and even Zerodha to some extent, they will literally give you all the money as limit immediately once you square off a position. The reason I continue with ICICI Direct is it gives you an option of eATM where you get most of the amount within 5 minutes in your bank account for the next trade. I'm talking about equity here. Also try to get 1 or 2 right trades, not 3 out of 5. During the times that we have seen in last 6 months, we realize that there is a bit of evolution needed. Slightly more than a year back, I thought that I'll partially retire, which means I will basically stop working for active income. So I had a lot of time and I thought that I could make quick money out of stock markets. For some period I could also, because the markets were in general going up and that happened to everyone. That habit I tried to repeat when the times got tough and that didn't work out. I over researched because I had a lot of time, and that also led to something called analysis paralysis, which means it became hard to take the decisions. Now what I have done is I go for higher probability of profit and a lower profit percent. This is also a problem. Let me explain why. Suppose you have won 2% in a trade. 0.5% will just go into your commissions and STT approximately. And now out of the 1.5%, you will lose 0.5% as income tax. If you lose 2% on a trade, you will still pay 0.5% in commissions and STT, which means the loss will be 2.5%. So there is a 1% gap between the two. So winning a trade and losing a trade are not equal in general. So this lower profit percentage actually compounds the problem, because if you are going for a 4-5% probability, then all these things get digested. You don't even bother about the accountancy. Also, I have separated out investment and trading in separate demat accounts for the simple reason that at times you get into a trading mindset and you sell your investments. Also happens most of the time to all of us. I am more open to sectors and stocks for trading purposes. Earlier I was doing this in within 8 to 10 stocks. Now I'm happy to try a few concepts, but again with very limited capital. Not more than 1 unit if it's a new stock. Some stocks are strict no if they don't meet my criteria, neither trading nor investment. There are enough ideas available. You could miss some, that's okay. Final set, when you are impatient, you get into feeling of missing out, and that doesn't help. I have gone into over trading also many times. Especially on good days, you start well, you make some money, and then you get overconfident and you say, okay, I'll do a lot of trades, same stock, other stock, indices, and so on. Most of these over trading days end up in severe losses. When I buy 100% quantity in one go. When I sell all the quantity in one go. Gut feel in investing, not a good idea at all. You have to do your research, etc., especially if it's an investment. Now, I am happy to catch the next bus, which means miss this opportunity, take the next opportunity, or catch the same bus from the next bus stop, which means buy it slightly higher. That is what laddering also is about in some ways. If you have already bought, then you could sell say 25 50 25. If you are planning to buy, you could do 50 50 50 50. What that means is buy 50% quantity once, then twice. If the stock continues to provide an opportunity or fall more, then maybe buy 2x as 50% more, 50% more. It's okay to go overboard in good quality stocks, especially if the opportunity is big. Gut feel is fine for trading. In fact, for me, I feel that my gut feel is powered by data that is in some ways AI, that the data is already accumulated over 1.5 2 decades. So it's okay, but trading, not investing typically. That too with limited money involved. If you have suffered in the fall in the last 6 months, then you would obviously know the reasons for them. Also, I've talked about them in some of them in the previous videos. Believe me, nothing has changed. Indian economy still has the issues which it had before the US induced fall came in. Earlier, we were falling on our own. I called that out in some of my videos. This is our own local problem. That local problem has not gone anywhere. We have done nothing to fix it. Just that right now we feel that it is all because of Mr. Trump. So if you feel that after 20% recovery in most stocks, maybe more in certain stocks, we are out of the woods, I don't think so. We might not make new lows in stocks and indices in a hurry, but I don't think there will be no new bottom in the next 1 year, 2 year. So am I going to stay out? No. Am I going to put a lot of capital in? That answer also is no only. It's all about capital management and staying patient. Do expect that there could be a reversal in the uptrend we are seeing right now anytime. Be happy to miss certain buses. That's okay versus losing capital. Preserving capital in today's time is gonna be very important. Hope this session was useful. Let me know in comments if you disagree with certain points or the ones that you resonate with. Thanks for watching. I will see you next time.